It's Monday, the 24th of June. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. So, thank you so much for joining us. Now, US markets have been hitting fresh highs, mostly because of AI frenzy, but the market breadth has been extremely weak, with just a few stocks actually carrying the overall market. Husseini is going to be joining us to talk about how to actually play this AI frenzy with a stock right here in Singapore, and also talk about ASEAN's internet sector. We are also joined by Jarek, who's going to be talking about industrials, and there's a lot more room to grow on this sector with a opportunity plus stock. And then finally, we have Krishna, who's doubling down on industrials with ST Engineering, and we are going to be talking about that as well. Now, if you haven't had a chance to download the newsletter, you can do that by scanning the QR code that's on your screen right now. Now, let's start with market movers. Market movers in last week, we did see the S&P down about 0.2%, mostly because of what we call the triple witching of the US markets. This is when $5.5 trillion of options expired, and that actually dragged the S&P down. We also saw the Hong Kong market, which is in the red, as well as the Japan slipped about 0.1%, largely because of the yen hitting about 160 without central bank intervention. So STI was one of the few markets in the green in ASEAN, which was led by the banks as well as the telcos. Now, as I said, there's a lot of AI frenzy out there. So when everyone's prospecting, when everyone's searching for gold, what's important is to sell shovels instead of you going out and trying to prospect for gold. And data centers is the latest shovel in this AI cycle. With that, we have Husseini on the line. Husseini, you wrote about Singtel, who is doubling down on data centers with a few deals that have been announced recently. Can you discuss what these deals are and how they will support Singtel?
Yeah, sure, Dylan, and thanks for having me. So Singtel last week announced two deals on data center, both significant. First is that they have tied up with Telecom Malaysia in Malaysia to build a 64 megawatt data center campus in Johor Bahru, which can be extended to almost 200 megawatt. Now, the current capacity of Singtel in Singapore is 62 megawatt. So that gives the scale that they are one campus alone. The first phase is going to be 64 megawatt in Johor Bahru. And in total, Intel is looking to add or take its data center capacity to 200 megawatt in the next 2 to 3 years with a very visible pipeline. The second announcement came that Singtel and KKR are jointly investing into STT GDC. STT GDC is one of the largest data center. Their overall data center existing capacity and pipeline is almost 1.7 gigawatt. Okay, and Singtel is going to invest $400 million into redeemable preference share, which will yield 6.5%, and it will also come with a warrant wherein Singtel, if it exercises the warrant, it will take 4% stake in the STT GDC. So net, Singtel remains quite focused on data center investments, and in our view, data center remains a strong growth area for two key factors. First is ASEAN remains relatively underpenetrated, so that creates a room for growth. And the second is this AI boom wherein, for perspective, a single chat GPT search consumes 10 times more data center capacity than a Google search. So that gives, or that indicates the kind of scale AI is going to take, and the companies are doubling down. Singtel is taking the lead in that space in our view. So we continue to maintain or reiterate our buy on Singtel.
That's right. Invest in the shovels. Thanks, Hussaini. So, Hussaini, you also released a very big internet sector report on ASEAN. I think it's a very, very unique piece. For the interest of our listeners and viewers here, can you give us the top three takeaways from that report? Should we really be optimistic about ASEAN internet?
Yeah, so we took a deep dive on the ASEAN internet space, and three key findings. First, all sector growth. We find ASEAN is 2 to 3 times underpenetrated versus more evolved markets like US, China, or Korea. For instance, e-commerce penetration in China and US is around 22 to 33% versus just 12% in ASEAN. And these evolved markets are also growing at a faster clip. So this creates a long runway for growth. Now, on e-commerce, we find ASEAN take rates are also on the lower side, around 20 to 60%, 60% below US, Latin America, and India. And this in turn creates potential upside. We also find competition in the e-commerce space very benign, even from TikTok, which was competitive last year, but now they have rationalized quite a lot. There are also entry of Temu and Shein, but we find it that the unit economics don't work for them, and they remain also rational. So on e-commerce side, we remain quite positive and see structural room for take rate improvement. On the other hand, on demand services, which is ride hailing and food delivery, here the market remains underpenetrated, but we see near term demand and supply challenges as well as risk of new entrant. So our consumer survey in various markets suggests consumer spending pressure, as well as our discussion with driver partners or drivers suggest that their earnings are also under pressure, which could create supply side pressure for Grab. Also to note is the entry of Zen SM in Vietnam and Indonesia. That also creates a risk in our view. So just to summarize, there is a long runway for growth. ASEAN is underpenetrated. On the e-commerce side, we remain quite positive. There are room to increase take rates. On the on-demand side, we see some near-term headwinds. So those are the three key conclusions.
Got it, Hussaini. So when we actually contextualize it, right, and we actually go in and drill into the stock level, I see that you've actually downgraded Grab to a hold. Now, 93% of other analysts who cover these stocks has a buy on it. So what are you seeing differently?
Yeah, so see, there are two elements. First is the GMV growth, and the second is the structural GMV growth long term, and the second is what we are seeing in the near term. So long term, I don't see that as an issue. It remains underpenetrated, but near term, I see multiple issues. First, as we discussed, that on the consumer side, we see pressure. We did run surveys in various markets. Around 65% of the consumers are looking to cut back on their frequency of food order or frequency of ride hailing or car renting in response to price increases. So I see pressure building up out there. And on the demand side, when we discuss with the driver partners, the monthly earnings they get from driving a Grab car is not very different from the NTUC cashier. So, and one of the reasons for that is that Grab has cut back on incentives quite a lot. So that remains a factor on the supply side. Also to note, one more important thing to note is that the current take rate in for Grab is around 20 to 22% for ride hailing and food delivery. Now, if you look at the global average, they are also like that. So structurally, the room to improve take rate is limited. Whereas for e-commerce, the take rates are low, so there is room to improvement. So that's the key difference. And finally, the entry of Zen SM in Vietnam and in Indonesia. Now Zen SM is backed by Win Group, the WinFast company. They also own the EV company called WinFast. And based on our channel checks and our survey, Zen SM has made a decent inroads in the market, and they are also the EV company. So their ability to navigate the odd even rule in Indonesia is also better placed. So we do see that as a risk for Grab and the reason for our downgrade.
Right. And on the opposite end, you've actually upgraded C's target price to $90. So what's driving that call?
See, on C, we raised our target price from 62 to $90. And the key reason or the key element for upside was the e-commerce side. We find ASEAN take rates on the e-commerce are around 20 to 60% below that of other markets like US, LATAM, and India. So this creates a potential upside. Competition remains benign. Risk from Temu and Shein are limited. Also to note is that on the gaming side as well, we believe the gaming business, the Free Fire business was a drag for the last 2 years on C Limited. Now that business is stabilized, and we see that going forward, management's focus or the strategy to make it an evergreen franchise, we see is credible, and it is mainly backed by increasing the engagement and lower monetization. So what essentially the management is doing at this point is that they are sacrificing near-term gains to make it a more sustainable franchise as far as the Free Fire goes. And those two factors are essentially driving our key, buy on C Limited.
Got it. Audience, this report is essential reading if you are really interested to understand how ASEAN Internet is going to really be growing over the next few years. So I really urge you to have a read of this report. Thanks, Hussaini, for joining. Now let's turn to industrials. This has also been a sector that has been doing pretty well over the past year to date. We have Jarek on the line, who's going to be talking about DYNA-MAC, which is one of our high conviction opportunity plus stocks. Jarek, you've raised DYNA-MAC's target price from 46 cents to 52 cents, and you're maintaining your buy call. What are the key developments that's actually driving this call for you, Jarek?
Hi, Dylan. Hi, guys. Basically, I think the key reason is more on earnings. We think that at the start of the year we were, I think, a bit too conservative on its potential margins. And then after that we did some channel checks and we realized that actually a lot of these FPSO builders, even like even like Seacham and the rest of the guys, they're actually enjoying higher margins for their new FPSO orders. So we do think that this will flow down to all the specialist builders which they subcontract up to, like DYNA-MAC, which is one of them. So DYNA-MAC specializes in the topside modules for FPSO. So with this, we do think that going forward, DYNA-MAC for its future order books and the orders that they secured recently would actually enjoy much higher margins than what we initially expected. And also, DYNA-MAC actually increased its capacity by 50%. So we understand that they are able to execute more projects, at the same time currently with the same or not, or rather just a small increase in labor as compared to previously. So with that, with a more efficient use of labor and space, we do think that net margins or operating margins for DYNA-MAC should actually improve much more than what we initially expected, with the better gross margins as well. So with that, we actually leave our earnings, by 24 to 25 to 27% for this year and next year, which resulted in the increase in target price.
Got it. So a lot more bullish on the prospects. Now, you also mentioned that Hanwha Aerospace bought out Keppel's 24% stake in the company, becoming a new substantial shareholder. How significant is this?
I think I think this angle is very interesting, but it's up to you to speculate. But from the facts that we have, basically, we understand that Hanwha actually bought another 3%, close to 3% off the open market before purchasing Keppel's stake, right? So basically, if you look at Keppel's stake, it's only 24%, but after purchasing or crossing over the block, they own in total close to 27%. So that means that they actually must have bought 3% off the open market. And this purchase was done, I would say the Keppel's block was done in May. And what more interesting is that, Hanwha actually announced in their official website through Hanwha Ocean that, it will be on a global expansion drive as it looks to expand its footprint in the marine energy solutions as well as shipbuilding. And with that, they actually also launched a bid in April for Austal, which is an Australian shipyard, for about USD 662 million, which was rejected by the Austal board for regulatory concerns. And with after that failed, then they started to buy, or they actually bought over DYNA-MAC stake in May. So it was all quite close and relevant. So we do believe that all in all, Hanwha Aerospace should be a potential positive addition for DYNA because Hanwha Ocean is actually the third largest shipyard, which was previously known as Daewoo, in Korea. So we do believe that they could actually sub out some FPSO jobs and give it to DYNA-MAC and work together on certain of these shipbuilding segments. And not only that, we do think that there's also a potential M&A angle on this front because of what Hanwha announced in the last few months. Yeah. So I think it's worth to take a look. Yeah.
Right. Okay. So global scale and potential other corporate action as well. Thanks, Jarek, for joining us. Now, sticking to industrials, Krishna has been highlighting the growing order book for ST Engineering. Krishna, welcome to the show. You mentioned that ST Engineering has secured about $100 million of defense orders from Europe. What is the significance of this, and how does this stack up for ST Engineering going forward?
Milan, thank you very much for having me once again on the show. So yes, indeed, for the ST Engineering, we think that this particular order win does augur well for the company. So we know that we are in an era of fractious geopolitics and defense spending are increasing. So this order win validates ST Engineering's capabilities in this space. It does increase their year-to-date contract wins for the defense and public securities business by about 6%. And to just to the context, this particular business is about 40% of STE's overall revenue for the first quarter of this year. So it is indeed a positive thing for the company. Further, if we see this particular order win, then it is coming from both existing and new customers. So it also broadens the customer relationships for STE in this particular business.
Got it. And you also mentioned that the MRO business or the aircraft maintenance business, the capacity there is growing. Can you give us an update on that?
Yeah, sure. So again, just as a context, this is another pillar of STE's overall business. This contributes another 40% of the group revenue. STE has been growing its hangar capacity globally, and they started growing this Pensacola business, the Pensacola hangar, back in 2018 to be closer to the customers. So the announcement that they made early this month is that about growing or building the third hangar in this particular facility. The first two has been done, and this will grow the overall hangar capacity by about a third. And this they are doing on the back of increasing MRO, the order book and contract wins, and which we think will be increasingly valuable for the company. We have already seen a lot of headlines coming from the airline aircraft mishaps. So I think there has been a period when some of this regular maintenance work has not been undertaken, and therefore having a more capacity on the MRO side does benefit for the company. And the final thing which I will mention about the stock is our thesis for the stock is on the yield and growth. So this yields about 5.5% and about mid-teens kind of revenue growth, EPS growth. And just as a reminder to the participants, this stock did help to pay the bills during the pandemic period when other kind of names actually stopped paying the dividends. So have a look. It's an interesting name and definitely one which will continue to deliver.
That's right, especially with increased global security concerns. Thanks, Krishna. Just on the nick of time, we have Nick, the chart guy, who actually has a technical on ST engineering. He thinks the stock will trade higher on the bullish readings on RSI. At the same time, he's also got another trading buy on venture, where trading momentum is picking up and the trend is meant to accelerate further. Let's have a quick look at upcoming events and macro dates. So we've got inflation numbers coming out on the 24th of June. Bank lending in Singapore will be out on the 1st of July. And the URA property price index is out on the 3rd of July. And also the GDP growth number, something that we are very keenly watching on, is out on the 12th of July. In terms of events, we've got two not to be missed events that are coming up. There is an event Discovering the Undiscovered, very interesting event on the 11th of July, where we have some undiscovered companies, including SATs, who will be presenting. All of the CEOs will be there, so please do join us. It's a live event at SGX. Please, you can scan the QR code to join that event. We also have investing in SRS strategies for the future with Nikko Asset Management, which is on the 26th of June. You can join that by the bit.ly link on screen right now. With that, we are unfortunately out of time. Thank you so much for joining us as usual, and thank you so much for your support. Your support is what helps us keep going every week, so thank you so much for that. And we'll see you next Monday, and have a profitable trading week.